we've said before, legacy is one of the most important things that you can do in your life. And we've got our wonderful leader, CEO and founder, Don Wenner. You can jump up on stage. Put your hands together for Don Wenner, everybody.
All right, everybody. So if you can do me a favor and grab these workbooks that everybody received. Get these out of your bag or wherever you have them if you can. I'll give everybody a minute to do that. And we are going to turn here to the Friday sessions. And you're going to go to right after, maybe some of you are already using this, right after the sharing worries, concerns, worries, and goals that you guys just covered, we're going to move into lifestyle planning. So it's basically the fourth page in here under Friday session. It says at the top, leading lifestyle planning, it says right at the top. And if you're here with your spouse, you guys can do this together if you'd like. And you're going to see there are, let me count these here before I confirm, there are 1, 2, 3, 4 pages, and then there's going to be the second set of 4 pages. So we had a little printing confusion, so I'm going to have everybody do a quick administrative task to avoid future confusion. So if you scroll to the 5th page where it says lifestyle planning, pre-retirement, then it says assets, real estate, cash, equities, fixed income, you'll notice a second set. So there's 4 pages in here twice. The second set, cross off pre-retirement. So the second set of 4 pages, cross off pre-retirement. And really what we're doing here to give you some more color is we're going to help walk through some lifestyle planning for where you're at today in your life. Now some of you, that means you haven't yet retired, and we're going to do a version of your financials today. And then we're going to do a set of your lifestyle planning after retirement. Now, if you're already retired, you can call it whatever you want. So you're going to do, in short, you're going to do where you're at today is the first section. Where your financials are today are the first 4 pages. And then the second set of 4 pages are a future state. So again, if you're pre-retirement, a natural is pre-retirement and post. If you're already retired, it might be today, and then it might be 5 years from now or 10 years from now. You can just pick a time in the future, whatever makes sense to you. And this isn't actually, we're not coming around and collecting this, right? So this is just for you guys. It's a way to think about our portfolio, think about our income, think about our lifestyle. And I think a more holistic way than probably most people do. I'm in an organization, actually, Chris, who was just up here, who was one of the leaders in, called Tiger 21. And in Tiger 21, there are, my group, which is in West Palm Beach, the average net worth of a member, about $500 million. Right? In my group, there's multiple billionaires in this group. Yet it's amazing to me, so many people when they join Tiger 21, they don't have this together. They have no clue what their expenses are. They don't have a clear picture to their income, especially those who aren't still working in their business. And they don't have a clear understanding of their portfolio. Not only do they a lot of times not even know what their portfolio looks like, but they haven't really thought about it from an income standpoint. Yes, your portfolio from an income standpoint, they haven't really thought about what their target returns are. They haven't really fully thought through what the risks are to what they invest in. And haven't looked at it as a whole picture. So that's what we're going to help you do today. And you don't probably, if you have this organized somewhere else, it might be easy for you if you know this off the top of your head. If you don't know every investment position you have, just the best that you know, or you're welcome to pull up information if you have it somewhere. But the goal is just to get us to think about things as a whole. And I think it'll help many in this room kind of think about their lifestyle planning, think about their estate planning, think about their wealth, think about their income, what they want to be able to do and how they want to live their life, a little different. So I encourage you, we're going to do a bit of kind of thinking about our ideal state here a bit. But first, we're going to start off here with this very first page here. I'm going to walk you through here a little bit. So we're going to go through and we're going to do on this first page here, which is this first page that you had to turn your workbook to. It's the first page you had to turn your workbook to. And we're going to lay out, we're going to start off with what does it cost you to live fully? And later this afternoon, we're going to talk about what living fully means. But what we'll mean here right now is for you to live the lifestyle you want. That might be, hey, you want to own a second home or a third home. That might be, you want to help your kids or grandkids or specific ministries. But whatever the expenses are that would let you feel you're living a full lifestyle, I want you to list those expenses out. So see in the bottom of that page, it says, first, home. It's got mortgage, taxes, insurance, repairs, and maintenance. So you're just gonna, if you own 2 homes, summarize those up as an example. Then underneath that, there is lifestyle, so food, travel, entertainment, just a miscellaneous bucket. And then we put a few there called other, or whatever, if you have specific other expenses that you want to list that are expenses that you have on a recurring basis. Then auto. Then there is, underneath that, there is insurance, life insurance, health insurance, disability, umbrella, and any other insurance you have. What are the costs of those insurance? Gifts and philanthropy. There's a spot there that says tithing, and then there's some open spots for any other types of giving that you want to. It might not be what you're yet doing, but if you said, hey, in an ideal world in 2021, I had all the income I needed to live the lifestyle I wanted, what would I give? Right? It might not be what you gave this year, but what would you give? And then taxes. If you're living a lifestyle you want, you might need to kind of do this iterative process and come back to calculating your taxes once you think about the income side better, but you can go in here and look at what you expect your taxes are now or what you think they are federal, state, local. Those of us in Florida, we don't have to deal with that thing called state tax, but I know some of you do. So why don't you start there? I'm going to pause there, and I want you to take a couple minutes and list out expenses. If you work ahead, then you're going to list out your stable forms of income, and you'll probably end up coming back to that as we go through our investment portfolios in a couple minutes. So list out expenses. Again, they don't need to be exact numbers, but what those general expenses are on the bottom, and then if you work ahead, start writing down your income source. And again, we're not collecting these are just for you, but I promise if you invest a few minutes in doing this, you're going to get some real value out of this exercise as we go through it. We have some people in this room who are in the financial services industry, and what you'll see there is very different than what traditional financial advisors would tell you is how you should allocate your money. I'm not here to say what's right or wrong, but the way we've filled this out, the way we've drafted this, especially when you get into your target picture, like what do you want to look like post-retirement, or in 5 years, or 10 years, when you think about how you want to allocate your wealth, allocate your treasures, you want to think about how that should be laid out. And I believe, again, these are my beliefs, that often those in the kind of financial services industry, they overcomplicate the number of types of asset buckets there are, and they misappropriately guide where assets should be allocated. And so in groups like Tiger 21 as an example, we get to see a quarterly report as to how all of the Tiger 21 members allocate their money. And every single quarter, the number one allocation is real estate. Yet that's not what most in financial services tell you, right? They call real estate an alternative, right? Real estate is the staple, in my eyes, of course. Everybody knows my world is around real estate, but to me, you have 4 main asset buckets. You own real estate, you own companies, whether that be in owning a public stock or private investment. You own debt, meaning you lend money to companies or real estate. And there's cash. And to me, those are the buckets. And you can break it out and nuance that if you'd like. And my belief is that somewhere between 10 to 33% of your wealth should be in real estate, 5 to 15% of your wealth should be in cash, or some form of cash. 10 to 33% should be in equities, private or public, however you decide, and we'll walk through those subcategories. 10 to 33% should be in lending, whether that be bonds or notes or lending funds, but lending money to companies or real estate. And then we're all going to have some sort of other category, and that you could put your personal art collection or automobiles or jewelry or anything else that doesn't fit in those buckets. We all have a little bit of our wealth in those types of things as well. So again, you're not going to fill in those now yet, but that's where you're going to summarize what's going to be on the next page when we get there in just a moment. And again, I'll open it up if anybody has questions so far before we move to page 2 here. And of course, you're going to keep these worksheets, so if you don't completely fill it out, I want you at least get the thinking and understanding here so you can complete this over the weekend. I was about to say or later, but I really want to encourage you. I believe much of what we're going to cover this weekend are things that we all know we should do, right? We should all know we should spend more time budgeting and thinking about our wealth. We all know we should do some more tax planning and estate planning. We all know we should be thinking more of a lot of the topics that you guys wrote on all these sheets that you guys are thinking about. But we're all busy, right? We're busy running businesses, we're busy running our families, we're busy on boards, and so busy that we neglect these things, right? The saying I always think about is, the urgent is rarely important and the important is really urgent, right? So doing all this type of planning is never urgent, and it's easy to push off. I've had people in Tiger 21, I'm by far the youngest member, and in my group, most members are 65, 70, 70. We've had people come into Tiger 21 at 65 years old, 70 years old, 60 years old, worth hundreds of millions of dollars, and they don't have a will and a trust, or they haven't touched it in 20 years, right? I mean, it's amazing how easy it is to neglect these types of things. And so I really encourage as much as possible to at least do some of this work here in this setting, because the reality is, when you go home, you're probably not going to do this work then, because you're going to get busy back with your kids or grandkids or life or work. So I really encourage you to take the time here now and over the weekend to do these types of exercises for yourself. But any questions so far? All right, so scroll to the second page for me. In the second page, you'll see at the top it says real estate personal and real estate investment. And I apologize, for some reason a line got put down the middle underneath those categories, so it makes it kind of hard to write, but just write over that line. So if you own one or two or three houses, you put those under personal. If they're just personal homes, you don't bring in any income off of them. And then any real estate investments that you have, other than your personal homes, you put underneath. I would include an investment, say, in the DLP housing fund, or the equity fund too. A real estate fund investment, you'd put under real estate, not our lending funds. Okay, you're going to save those to the lending or fixed income category, is how I would recommend. And then, so starting with your real estate, real estate's the most complicated one in a way because of leverage, especially if you own real estate directly. So the first column would be how much equity do you have in the real estate? If you own in a partnership, you could put what percentage of ownership. If you know if it's in a fund, you don't have to worry about that. What's the target return of that investment? What are you targeting? What is the target income? And those are two very different things, right? There's a lot of investments that produce very little income, but the returns are all at the end when you exit, right? So what is the target return, and what is the income that you can count on, that you're expecting off of that investment? And then how would you rate the risk of that investment? So that's your choice how you want to think about risk. 0 being no risk, 10 being super high risk. Investing in your friend's startup might be a 10. But how would you rate that risk? How liquid is that investment? That's an important factor to think about, is liquidity. And then the last three columns are, in real estate only, is what's the total value, what's the debt, and that'll create your equity. So if you say, hey, it's worth $1 million, I own 700 grand, then you'd write 300 grand under the equity category. Then as you move to cash, that's pretty straightforward. You just list the different forms of cash you have. You can just categorize, just cash, maybe CDs, whatever forms of cash you have. In the ownership column in all of these, you might want to denote here, do you own that in your personal name? Do you own that in your trust? Do you own this asset within an insurance policy? Do you own this in your IRA? What's the ownership structure? And as we get through some of the topics this weekend, it's really important to think about not only what assets you have, but how do you own them? How do you protect them? How do you maximize the returns from tax? So that's what that ownership category is, to put how it's owned in your family trust, in your IRA, your 401k, in your insurance policy. What's the ownership of that asset, or is it just in your personal name? And then if you don't have much in real estate, that won't take you very long. And then the next page after real estate and cash is equity, or equity. So we have it broken there out between public equities and private equities. And then we have a third category of private equity operating businesses. meaning these are the companies you run. So you can imagine, for me personally, you know, I own a bunch of companies, right? That's different than me investing in somebody else's private equity fund, right, that I have no control over. So you break that up. You're still running your own business. What's your business worth? If you're investing in other private equity and then public equity. So you can just put one category of stocks if you want, or you can break it down to whatever detail you want. In this document, we had to print this out in some formatting, because normally we do this in an Excel workbook that's all pre-formatted, does all the calculations for you, flows it all really nicely, and we're going to send that out to everybody here. So if you want to go through this and do that in that format, but we wanted to print it out here because we knew not everybody's going to bring their computer and be able to pull it up, but we're going to send that to you. And I've been using this tool for a long time, and I use it regularly. This is what I use when I have to come to Tiger 21 and do a portfolio defense and present to the whole group my financial picture. So I do this, I keep it up to date, I update it every month, and it really helps me in thinking about my portfolio and my lifestyle planning. So again, here under equities, what's the value of the investment? How do you own it? Is it owned in a trust, in an IRA, a 401k, your personal? What's your target return? Your target income? Does it produce dividends? Does it produce income to you? What do you think the risk is? That's your opinion of risk. And what's the liquidity? Some are maybe completely illiquid, but what's the liquidity of that investment? Obviously, one of the benefits of public equities is it's very, very liquid. Right? And then after we do equities, then the last page here is fixed income, which we categorize lending into fixed income, which I believe that's what fixed income is. It's essentially lending money. So we broke that into 3 categories: bonds, notes or loans, and in lending funds, such as the DLP lending fund, the income growth fund, the fixed fund, deposit note fund. You put those, well, you put the first 3 under lending LP, you'd put the DLP deposit note fund, or if you have a fixed note with DLP, you'd put that under notes. And then again, value, how do you own it? What's the target return, the target income, the risk, and the liquidity. And then lastly, just any other category. So automobiles, personal property, jewelry, art, whatever else you have. And so in each of these categories, there's a total category for your total value, your total return, your total income. And then in the Excel version, we'll send you, it'll calculate your average risk of each category, all those types of factors for you as well, your blended return, etc. But in this case, you're just going to go through each section, total up those categories, and then the very bottom, total up all of them, your total assets. You're welcome to pull out your phone calculators and at least list out your total assets and your total income are the really important ones that we're going to carry forward back to the first page. Maybe you're still working or you have plenty of income and you have investments that do produce income, but you reinvest that income, still count that as income, right? So one thing we're going to help you look at is when, if you do retire in the future, you do need those income sources, thinking about your investments as a way to produce income. So encourage you, example, our funds, they all produce monthly income, but you may be reinvesting it, still list that as income. All right, so guys, I'm going to, as you guys continue to fill out here, I'm going to open up, we'll grab a question here, Bo, and we'll answer some questions, but then feel free here. We have Ben, who just stepped out. He was the man in the back of the room. He was a little taller than I am. He'll be leading an awesome discussion at 11 with Steve Jabara, who's got a pretty amazing story and background as well. So we're going to lead an awesome discussion, kind of panel discussion at 11. But if anybody needs a break here over these next 40 minutes, you're able to do so. Go grab coffee, walk around. If you need to go to your room, you need to make a phone call, whatever you need to do, feel free. You're going to want to be back here at 11, I promise you. It's going to be a really, really cool session at 11. But we're going to continue to open it up for questions, and if you guys keep working through this, use this as a workshop opportunity. But make sure you're in this room at 11 for Ben, for sure.
In general, I'd like you to elaborate on this too. What is your feeling as far as how often this should be updated? Because this is a moving target for most people in this room. From your perspective, what is a good timeline to reassess this annually, semi-annually, monthly, or obviously major events in your life, but outside of the major event things, what is your take on that?
My short take on how often you should be looking at your portfolio and doing this type of exercise is at least quarterly would be my recommendation, or anytime there's a major change. And that could be a life change, like you said. It could be, if you're heavily invested in the market, the stock market, and there's a major change there. I would encourage you to take a relook at it. Anytime you make a major change to your financial situation, the market forces a major change on your financial situation. But I think just out of routine, what I do, and I don't pay close attention to what happens in the day-to-day stock market. It doesn't affect me on how I think about my investments. It doesn't change my planning in any way. But still, I go through discipline doing it at least every quarter. Sometimes I do it more often, especially in between if I have to present at Tiger 21 as an example. But I use this as the tool I use to create my to create my personal financial statement, which I have to provide certain lenders and so forth as well. So I really keep it up to date monthly. But I say it depends how diverse and how often things are changing for you. But I think a good discipline is quarterly. If you have never done this, you're not doing it at all. If you could just get in the habit of at least doing it annually, it would be a huge step forward, I think, for many. Just getting it down on paper once, and at least once a year, doing a full review. But annual, I think, is the best discipline for most. Thank you. Good question.
I'm gonna share a couple things. I'm gonna actually share something that took me about 20 years to learn. But hey, I learned it. Better late than never. So how many public companies do you think there are in the United States? Just take a guess. How many public companies? Any guesses out there? Somebody said 5,000. So, okay, we got 50,000, is there 100,000? So it depends where, there's some public companies that don't trade at all. They're on the pink slip, or anyone hear about that? So just call it 4,000 or 5,000 actively publicly traded companies. So let's just pick 4,000, okay? That's it. There's almost 400 million Americans, and there's 4,000 actively publicly traded companies. That's it. And not all 4,000 are good, by the way. Okay? So say half are bad, right? So now you're left with 2,000. So picture a pond with 2,000 fish in it, and the smartest men and women in the whole world are trying to catch one of those fish. 2,000, that's it. Now if we step over here into private companies, okay, there's about 10 million of them. There's about 10 million of them. So I can't go to Merrill Lynch. I can't go to sorry if anyone has Merrill Lynch. I'm just going to pick on Merrill Lynch. I could pick on JP Morgan. I could, they're all kind of the same. I can't go to Merrill Lynch and say, hey, I want to invest with DLP. How many of those 10 million private companies are on the Merrill Lynch platform? Less than 1%. But yet, when you go to Merrill Lynch and your Merrill Lynch person's talking to you, they want all of your capital, okay? They say, hey, we have open architecture, we can invest in everything for you. And that's a departure from the truth. That's a departure from the truth. So you heard about Tiger 21, you've heard about these other groups, there's investment groups. There's one of the biggest migrations in human history that's happening right now. And it's people going, well, wait a minute, my Merrill Lynch person, they really can't, why is it DLP on Merrill Lynch? And here's why. Let me give it an example. So what the conversation would look like this if DLP went to Merrill Lynch. The first thing they'd say is, well, we want a big company. We want 5 billion, 10 billion of assets. Okay? Well, great. There's a lot of great companies. Look at DLP. There's a lot of great operators that are doing very well that don't have 5 to 10 billion. The other thing that Merrill Lynch wants to do is oftentimes they want to share their fees. Hey, we'll put you on our platform, but you got to kind of share some of your fees with us. Well, wait a minute, you're already charging a fee for your client to manage their wealth. Why do you want some of our fee? That doesn't make sense. And then the other thing they say is, you have to switch and use your banking. We want you to use Merrill Lynch or Bank of America for your bank. So if you say no to any one of those things, you're game over. They're not interested. So many firms don't want to get on there for just the reasons I just recommended. So the big takeaway here is, hopefully, and by the way, the good financial advisors, the really good ones, will look you in the eye and say, you know what, we really don't have access to that much. You know, there's 10 million companies, there's only 2,000 good public stocks. You know, we can take some of your wealth and help diversify it, but my gosh, 99% of the stuff that's out there is not on our platform and never will be. The good ones will tell you that. But if somebody does say to you, hey, yeah, we can diversify, we can put you in everything and we're great, just know that that's a departure from the truth, okay?
Thank you, Bill.
Yep.